Hello, everyone. Hope you're all doing well and enjoying your weekends. I wanted to create a quick video discussing a really interesting opportunity that we're going to have next week. I will try my best to keep the video as short and direct as possible so you guys can get the most information within the shortest period of time without any fillers. So let us just start with it directly. All right. The US indices in general have been moving in an extreme bearish trend since the beginning of the year, with the dollar increasing in value also since the beginning of the year. Now, the main reason for that, if we're going to talk about basic fundamentals real quick, is during the COVID-19 pandemic, the Federal Reserve has printed 80% of the dollars in existence. And throughout that period, so the money supply has increased drastically, devaluating the dollar. If we can go ahead and take a look real quick, let me see. Here we go, the money supply chart. So you can see during the COVID-19 pandemic how it just skyrocketed to the upside. In basic economics, when you have an increase of supply, and during the COVID-19 lockdown, there was no demand, there was a very strong devaluation of the dollar. So the dollar dropped quite strongly, right? So in response to that, throughout this year, the Federal Reserve has been hiking interest rates. And the reason why they hike interest rates is to increase the demand on the dollar. Now, the way they do that is by hiking interest rates, the cost of debt becomes higher, which means consumers are less likely to borrow. And if consumers are less likely to borrow, then consumer demand is going to go down, and that will bring a higher demand on the dollar, pushing the dollar to the upside. And confluencing it, this will push US indices and US equities to the downside, and it will also push gold to the downside. So this has been the main bias throughout the year, throughout 2022. If we look at, let's see here, we have the S&P 500 to the left, Dow Jones in the middle, and NASDAQ to the downside. This is year to date. We are seeing a clear bearish trend throughout all indices, and this is on the daily time frame since the beginning of 2022, right? So let's go back, right? So throughout the year, we've been having waves, of course, because the market moves in waves. We've been having pushes to the downside, pullbacks back to the upside, then with a more hawkish tone from the Federal Reserve, indicating that they will increase rates again, more bearish momentum on US indices, pull back after the interest rate decision before the Fed jumps back in and says they will be raising interest rates even more to combat the high pacing inflation, right? And then it pushes back even further. Now, with that being said, the main indicator that the Federal Reserve is looking at, and we as investors are looking at in regards to seeing how inflation is doing, is the CPI, right? So as we can see, just by looking at any economic calendar you can find and pressing on the CPI, you can see that the CPI has been increasing drastically. And this is an indication that inflation has been increasing drastically. Throughout the year, the Federal Reserve has been hiking and hiking interest rates over and over and over again, and there are still no signs of inflation slowing down. And if we can take a look, okay, let's see over here. So here I have made a chart where you guys can see that United States inflation rate, right, which is the black area, the black line you can see guys over here, versus the United States interest rate decision, right? And you can see since the Federal Reserve started increasing interest rates, inflation was supposed to, on a theoretical level, to start to slow down. However, there has been no signs of inflation slowing down, and that has kept the Federal Reserve extremely hawkish, and that has kept on pushing US indices to the downside and pushing the dollar to the upside, right? Now, last FOMC press conference and interest rate decision, the Federal Reserve raised rates by 75 basis points, right? Which was expected and already priced into the markets with this move over here. One moment. All right. After that happened, there was a strong, and it is the strongest pullback to the upside this year. Now, I want to discuss that for a little bit. Now, it is, if you understand how order flow works, and you understand that there's always a gap between fundamentals, reality of fundamentals, and what investors believe are the reality of fundamentals, you'll understand how order flow works. Because what happens usually is investors start to price in a certain fundamental, and then if it comes out true or untrue, the market reacts accordingly, right? So the last FOMC, the Federal Reserve went ahead and hiked interest rates by 75 basis points, right? Which was expected. However, throughout the press conference, Powell slipped a couple of headlines indicating that they will be slowing interest rates down, meaning they will be moving from hiking 75 basis points, right, to 50 basis points. Now, investors have taken this specific headline and they have stuck to it, meaning they have interpreted the whole FOMC press conference as being dovish, right? This is what investors have interpreted the last FOMC press conference, that the recession is ending, inflation is going to slow down, the Federal Reserve are starting to slow down on interest rate hikes. Instead of hiking 75 basis points, now they're hiking, they will start to hike 50 basis points instead. And that should mean that the inflation is slowing down and the economy is doing better. Hence, we have found a much stronger pullback this time around after the interest rate decision, right? So we can notice with the other pullbacks, they weren't as big as this one because the Federal Reserve remained hawkish overall. So we have this one, right? And now we have this one over here. Okay. Now, here is my personal opinion and where I see there is a huge opportunity to be taken next week, right? Retail, you have to understand that retailers and investors are extremely emotional decision based. Their decisions are based on emotions. The only thing that investors have been wanting this year is two things: is for the stock market to bounce back and for the crypto market to bounce back, because everybody is in this huddle, flying to the moon type of phase, where they believe everything will just skyrocket, right? So as soon as there was some sort of signs that the Federal Reserve is going to cut down on interest rates and start to start to slow down interest rate hikes, they immediately jumped on the opportunity, and you can see this strong bounce from the latest interest rate hike to the upside, right? Now, this is actually wrong, in my opinion, because there's no data that backs up the fact that inflation has slowed down, right? They're just interpreting that. And if we actually go ahead and take a look at the headlines that were actually presented, actually, let me go ahead and really quick screenshot it from our Discord server. One moment. Here we go. All right. You can see that people did not actually really pay attention to what was said, right? So if we take a look and we pay attention, we will realize that, for example, Powell said another exceptionally high rate hike may be appropriate depending on the data, right? Depending on the data. Further surprises could be in store, right? What also did he say? It's most likely reasonable to slow the rate of increase when interest rates become more attractive. Okay, that is like neutral, right? It also goes back to the point that it depends on the data, right? It is likely slowing increases will be appropriate at some point. He never said the next interest rate decision will be that point, right? I would not hesitate on a larger move if needed, right? So yes, I would take these estimates for rates next year with a grain of salt, right? So the investors and retailers and the way the market reacted to the FOMC press conference was a total overreaction and a totally incorrect reaction, in my opinion, right? And the reason for that is because there is still no proof that inflation has slowed down, right? And also they took the fact that Powell said that the US is not in a recession, and he changed the definition. A recession is defined as a broad-based decline, which does not appear to be the case right now. At the end of the day, PMI figures are to the ground, consumer confidence levels are to the ground, and initial, what was it called? Jobless claims keep on getting higher and higher every week. So the US is definitely in a recession. Like, there's no argument about that, right? He just changed the narrative, changed the definition, but that does not change the actual data behind the US's economy, right? So let's put that to the side right now. So now we both agree that the US is in a recession, and there's actually no proof that inflation has slowed down. The Fed is just acting, or gave a little bit of headline that they might be slowing interest rates down, where investors just completely overreacted in the market, right? And this is why we saw this huge push to the upside. Now, on the 10th of August, right? On the 10th of August, it is the data for US Consumer Price Index, which will be the representation of inflation, will come out, right? And the forecast, you can tell already, investors are expecting for CPI to drop, according to the last FOMC press conference, right? They're expecting the CPI to drop, and so in return for inflation to drop. Now, if that did not happen, if inflation did not drop, if inflation actually increased from previous figures, what would this mean? This would mean that this whole move to the upside is completely invalidated, because this whole move to the upside is solely based on investors reacting to the FOMC press conference and interpreting Powell's words for a dovish tone from the Fed, right? And this is the main reason we saw the pullback to the upside in US indices. This is the main reason we saw gold pulling back to the upside. This is the main reason we saw the dollar pulling back down to the downside, right? And they are just retracements in an overall, still for US indices, an overall bearish trend. Now, if CPI comes out higher than forecasted, right, and more even higher than previous numbers, right, which is 9.1, right, if it comes out higher than 9.1, this whole move will be immediately corrected. And you guys can apply that not only to, I'm using Dow Jones as an example, right, dollar payers, and any other, like, if you guys understand the basic confluences between currencies, you can take that information and apply it to a lot of instruments, right? So this will present us with a really, really, really good opportunity, right? Because the way the market moves is, for example, they make they follow some headlines about certain, let's say, for example, an interest rate hike. Let's say the Federal Reserve says we're going to raise 75 basis points, right? So the dollar starts to go up, before the interest rate decision comes out. Let's say the interest rate decision does come out and they don't raise hikes by 75 points. They raise it by 50. Then boom, it gets corrected because this move to the upside was based on a 75%, 0.75% rate hike. And what you actually got was 0.5, right? So this is what you have to understand within the market. It is investors pricing in what they think is going to happen within the data, looking to the future, forecasting, right? And then acting accordingly. And then they see what happens when the data comes out, right? So in this case, they are pricing in inflation coming down, right? And the Federal Reserve raising 50 basis points and starting to slow interest rates down, right? If that is not the case, then this will be completely corrected and the Federal Reserve will come out, and either Powell or Barker or whoever from the Fed members will come out and start saying, oh, according to the data, we did say that it was according to the data, right? That we will judge if we will raise interest, if we will slow down interest rate hikes or not. But since the data, since inflation is going up higher, right, then we're going to have to go back to raising 75 basis points, right? We did say further surprises could be in store. We did say I would not hesitate on a larger move if needed. They have the ways to back out of it, right? It's typical central bank talk. And if that will happen, the Federal Reserve will jump and say, well, we are going to start raising, we're going to go back to raising 75 basis points. The 50 basis points was based on if inflation slowed down. Inflation did not slow down, so we're going to raise 75 basis points instead. And then this will be corrected completely. And this is one of those trades that if you understand what is happening in the market and the fundamentals that are moving the technicals, it will be a really, really easy and simple trade, right? And it is a big move. We are on the daily time frame, right? Which most people, I don't know what time frames you guys trade, but more like if you look at it from an hourly perspective, right? This is a huge move to the upside, right? And this will be completely corrected if inflation goes higher, because the Federal Reserve will react by hiking interest rates even more aggressively and a more hawkish tone, you know? So that is the idea I wanted to give across. It's a really good opportunity, right? And if for some reason we saw inflation starting to slow down, then you can expect further bullish momentum on US indices, further bearish momentum on the dollar, right? And then you can actually play it on the opposite side. You can play more bullish momentum on US indices. It is a really simple trade if you understand fundamentally what's going on, right? And this was the main idea and perspective that I wanted to get through. Of course, if you have any questions, you can contact me either on our Instagram page or through Telegram, or leave a comment in the YouTube. But yeah, we will be attacking that in details within the Discord server. We have done that with every major economical event within the past year, regardless the Fed, the BOE, Bank of Japan, the European Central Bank. So we've been attacking those with extreme precision, just by understanding what is moving the market and how investors react and how it gets corrected, and the gap between what fundamentals are and the interpretation of investors. And if you understand that gap, then you will understand that is where your arbitrage opportunity is in the market. Thank you guys for listening, and we'll stay in touch till the next video.